Leverage has a place in your retirement account. In this video, I will discuss how leveraged ETFs work, why you should not buy and hold them, and how a sophisticated investor might use them in a Roth IRA to turn scary market dips into a strategic, tax-free opportunity. Let's start with how it works. Leveraged ETFs promise amplified exposure to the market, 2x, 3x the daily returns of major indices. But what's often misunderstood is how they achieve this, and the very real risks they introduce. Let's start with a common misconception. Leveraged ETFs don't simply borrow money to buy more stocks. Instead, they use what's called synthetic replication. That means they gain exposure through a portfolio of financial derivatives to deliver a multiple of an index's daily return. The most important and most misunderstood feature as a result of this setup is the daily reset. Over a single day, a leveraged ETF can do what it promises, 2x or 3x the return of the index. But over longer periods, especially in volatile markets, the results can deviate significantly from expectations. Here's an example. Imagine an index starts at $100. On day one, it falls 10% to $90. On day two, it rebounds 11.11%, which brings it right back to $100, a 0% return overall. But a 2x leveraged ETF doesn't experience that same round trip. Even though the index is back to break even, the leveraged ETF is now worth only $97.78. That's a 2.22% loss, purely from volatility, not fees, not tracking error. And this isn't just theory. In 2022, TQQQ suffered a max drawdown of over 80%. To recover from an 80% loss, you need a gain of 400% just to break even. That's not investing. That's a coin toss with loaded dice. Just one bad year can lead to a lost decade. Because of rare but big drops, leveraged ETFs are not suitable for buy and hold. But that doesn't mean they're useless. In fact, when used strategically and with strict discipline, they can be a valuable tool, especially inside a Roth IRA. During significant market downturns, leverage allows you to capture the recovery, or what's often called a snapback rally. With a Roth IRA, you don't need extra contributions to gain more exposure. Any gains you capture will be tax-free. So how does a responsible investor tactically use LETFs in a Roth IRA? It comes down to three components: position sizing, entry signals, and disciplined execution. On position sizing, any leveraged ETF allocation should be treated as a speculative sleeve, a very small, clearly defined percentage of your overall assets. Think 1 to 5% max. The idea is that a complete loss would be financially painful, but not portfolio ending. In short, a calculated risk, not a reckless one. The entry signal must be rules-based, not emotional. A proven approach is to wait for the market to fall significantly below a long-term trend line, such as the 200-day simple moving average. This is when leveraged ETFs are at their most bruised and where the snapback potential is highest. Dollar cost average into the downturn, gradually building a position as the market sells off. You're methodically buying low, waiting for the mean reversion rally to do the heavy lifting. Leveraged ETFs can serve a precise function inside a retirement portfolio, a small, tactical position taken at times of extreme dislocation. But the emphasis here is on tactical. This is not a strategy to automate, set on autopilot, or forget. It requires attention, discipline, and a clear set of rules. But what about the more complex strategies, the kind you might hear about on forums, spreadsheets, or finance subreddits? One such strategy that gained traction is popularly known as Hedgefundie's Excellent Adventure, a model portfolio combining leveraged equity exposure via UPRO with leveraged long-term treasury exposure via TMF. The core idea? Diversify your leverage. When stocks go down, bonds typically go up, creating a balancing effect. In theory, the portfolio compounds both sides while minimizing volatility. But theory doesn't always match reality. In 2022, both US stocks and bonds fell sharply, driven by an inflationary regime where interest rates spiked. That critical assumption negative correlation broke down. UPRO and TMF lost significant value simultaneously. The strategy didn't just underperform, it unraveled. This leads us to what may be the most dangerous risk of all: behavioral risk. It's not just about what a strategy can do on paper, it's about what an investor can actually stick with in practice. All the elegant models in the world can't protect against panic selling during a crash or throwing caution to the wind in the middle of a euphoric rally. As always, the path to real wealth isn't speed, it's strategy. Whether you use leveraged ETFs or avoid them entirely, the key is clarity, control, and commitment. Do you use leverage in your portfolio? What strategy worked for you? I would love to dig into the rat hole with you in the comments below. If this video helped you rethink how you use tools like leveraged ETFs, subscribe for more insights built on data, not hype. This is Weekly Compounding, and this is how we build intelligent portfolios for long-term wealth. This video is for informational purposes only, not tax or investment advice.